Hello, everyone. Thanks for joining today. My name is Grayson Geiler. I'm with SES Services. We are giving weekly market updates. We're taking a financial topic from the headlines, and we're going to go into detail about it. Thank you for attending. Keep in mind that as fiduciaries, we aren't giving specific financial advice to anyone through these webcasts. We would have to know a lot more about a specific person's situation before we're giving advice. So just consider that these are broad and general market updates and education in general. So what I'd like to talk about today is the inversion of the yield curve. So specifically what that is, by definition, it's when the 2-year interest rate is higher than the 10-year interest rate on the U.S. Treasury market. Interesting situation. Remember back in 2020 in the spring, the Federal Reserve poured a lot of liquidity, as they call it, onto the market. They were conjuring money out of thin air, and they bought about $80 billion per month worth of treasuries and another $40 billion per month of mortgage-backed securities, among some other things that they were purchasing from the free market. So they poured a lot of liquidity onto the game, and it doesn't take a Rhodes Scholar to figure out that at some point you're going to get some inflation when the Federal Reserve is doing that. Well, here we are. We've got the inflation. We're running at the highest inflation rate that we have in 40 years, all the way back to the early 80s is the last time we had this. I think the last CPI print was 9.1%. So a lot of people are nervous. The gas prices are way up, food prices, just the cost of living in general is a lot higher. And now the Federal Reserve is trying to normalize this situation. They've pulled back. They're not doing those purchases of $120 billion a month, and they're raising interest rates. Consequently, some unintended consequences, we have an inverted yield curve right now. And one of the criticisms about inverted yield curves is, well, it is an indicator that the economy may be going into recession, but what about the timing of it? Because historically, an inverted yield curve can predict a recession, but you don't know when. Somewhere within a couple of months to actually currently going on like we are right now, to maybe 4 years down the road historically has happened when the yield curve invert. So let me show you a chart with respect to this. You look back at this chart. It's when we get below zero, the gold line on this chart. That's when the yield curve is inverted, as defined again by the 2-year Treasury rate higher than the 10-year Treasury rate. Well, of course, when we're looking all the way back here in the early 80s, this was when Volcker raised the discount rate to almost 20%. Well, long rates, at the 10-year, 20-year, 30-year end of the curve weren't quite as high. So you had an inverted yield curve to the tune of 2.5%, a hugely inverted yield curve. Well, and then of course the shaded areas on this chart are recessions, and we had a recession that followed. Had a similar situation in the early 90s. The yield curve got inverted. We had a recession that followed. 2001 through, we had the 9/11 event, of course, in 2002, 2003, we had a recession. Yield curve inverted in 2005 and 6. And of course, we had the 2008 meltdown. And here we are inverted in the yield curve again. The one thing I would point out is this is a lot different than last time. The last time the yield curve inverted, or not the last time, but the 1980 event, this was because the short-term interest rates were so high is why we got inverted in the yield curve. Well, now we are inverted because the long-term rates are so low. Now, you've probably heard in the financial press, the interest rates are going higher. Well, the 10-year yield on the U.S. Treasury did get up to 3.5%, which is the highest we've been, in over a decade. But that was in mid-June. Now we're back down into the twos. Last week, I think it printed about 2.6%. So with the front interest rates, near-term interest rates going a little bit higher, it's the very low long-term interest rates that have inverted the yield curve. again, still indicating that there's an economic slowdown coming. We are in a recession. Some politicians are trying to change the definition of a recession, but historically, it's always been 2 quarters of negative economic growth. We're there. It's a very mild recession as it is now, but we still have an inverted yield curve, so maybe things are going to slow down a little bit more. But again, just very interesting with where inflation is right now, that long-term rates are so low, because intuitively, a long-term bond investor, if inflation is running hot, they're going to want a higher yield on their investment, with the inflation chewing away at their returns. And that's not what's going on right now. So the market is saying, hey, maybe inflation is going to come in a lot. But again, the distortions that the Fed has induced, pouring so much money onto the game, this could be just another unintended consequence. I'd like to give you a definition. Milton Friedman is a famous Nobel laureate in economics. And his famous quote, he said that inflation is everywhere and every time a monetary phenomenon, and it only happens when there's an increase in the money supply that outpaces the increase in production. Well, I'm gonna respectfully disagree with Mr. Friedman at this point. It's not all a monetary phenomenon what we're experiencing right now. You look at, I mean, the energy prices in particular, it's a direct result of government involvement. We have supply chains that have broken down because of the COVID issue. As time goes on, if these things normalize, a lot of the drive for inflation is going to come back in. It's not a monetary phenomenon right now. So, of course, the question is, we still are sitting on an inverted yield curve, and what does that mean going forward? One of the things that the inflation data that the Fed is going to be watching, and whether or not they're going to continue to raise interest rates, is the employment data. And the employment, this was another curveball thrown at the financial markets last week. Employment data was way stronger than anticipated. The unemployment rate is way down, which intuitively, that's a good thing. The economy is doing well, and the economy is doing a lot better than one would have expected with interest rates rising. I would caution people on getting too excited about the employment data. You look under the hood, and some of the things that we see just aren't so rosy. The increase in wage growth is not keeping pace with inflation, and the increase in wage growth is slowing down, which is a concern. On top of that, a lot of the employment growth is from temporary part-time workers. We're at an all-time high of people having multiple jobs. So a lot of bartenders, a lot of waiters and waitresses were hired in the service industry, which is good for the near term. But if the economy turns south with any vigor, and those are the type of jobs that get lost first. So you look at some of the other economic data, and it's wildly contradictory. You see that kind of employment strength. You look at the housing market as a perfect example. I mean, mortgage rates have gone so much higher so fast that there's a very big slowdown in the housing market, which is something that has people really concerned. But again, the stock market has bounced back from late spring, early summer doldrums. The bond market has come back. So we're better than doomsday right now, and things. A lot of people are calling this a bear market rally, which may be the case. If you are in a situation that you've lost sleep over the last couple of months because your portfolio was taken on water, please, this is a great time to rebalance your portfolio. Things are looking stronger, but let's not get excited and load up the credit card on a late summer vacation for the family, because there are some indications that things are slowing down, and of course an inverted yield curve is one of those biggest indicators. So that's our update for this week. If we can help in any way, let us know. If you enjoyed the content, please click below the like and share and subscribe to our channel. We're going to continue to put out weekly updates, and appreciate your time, and I hope to see you back in the near future.